John Beacham, CEO of Toorak Capital Partners. If you're in the private lending space, especially on my side of the fence as a lender, and if you have any presence at conferences in this space, you know Toorak. You probably also have run into Mr. Beacham here as well. So thank you for flying down here. I know you had a big reason to be in Greenville, and it wasn't the podcast, but I appreciate you carving out time. I really do to come here and chat with me.
Well, thanks for having me here at Dalton. It's a lot of fun. I love Greenville. It's a beautiful city here. And it's not often I find myself in Greenville. So very excited to come in here. And I was last here, I think, about 5 years ago, actually, when we were doing business with Lima One. And it's just so wonderful to see this company have grown. I mean, I think there was like 50 people when I was here last time, and same facility, but massively larger. And so all the success that Lima's had over this year is really great to see.
Yeah, I know you and your firm played a big role in that success during those years. And I know it's been great that we've all been able to stay in touch on the conference circuit, and we'll get you back down to Greenville more often. And we got to get up to your neck of the woods when it gets warmer. But walk me through, I being a fan of this space and having been around you a bunch, have a good grasp of your background, but I think it's really important for listeners to kind of get a view of that. So walk me through your time at Deutsche Bank through today and just that journey.
Sure. Well, as probably many people, I sort of didn't expect to end up in this job. I sort of went through a path and a series of choices. I graduated from college. I worked in investment banking, covering insurance companies and banks, actually. So financial institutions related, but not anything to do with mortgages in particular. Then later in my career, I actually had a chance to go buy a company for Deutsche Bank. That was a multifamily mortgage company. So advised Deutsche Bank internally on that acquisition when I was a banker at Deutsche Bank. And that was really cool. So after that, I got to learn all about real estate and mortgages. So joined the commercial real estate group and started doing large amounts of commercial real estate lending. When I was there at Deutsche Bank, I was the new person in the real estate group, so I didn't really have a real estate background at that time. And so I would do everything that was kind of a little bit more esoteric or a little bit more unusual. So I wouldn't do a beautiful building here. It's an office building in Greenville. I wouldn't do a loan in this building, but I would do cold storage centers or casinos or restaurants or things that are a little bit different and a little bit unusual when I was there. Throughout the crisis, I worked, my last loan was a large loan to a casino company. So led to the casino company, really great timing in 2006, right before the financial crisis. It closed in 2007, so that didn't go so well. So I ended up learning a lot about bankruptcy, workouts, and other things that are really, really useful, actually. I learned a ton in that process. Also a lot about Vegas, casinos, whole different podcast. But then after that, actually kind of more relevantly, then in like 2012, I was still in the commercial real estate group at Deutsche Bank. And I started getting calls from Lou Ranieri and Blackstone in the same month saying, we want to do something that's kind of different. We want to go buy single family houses. Okay. I've never heard of, at that time, actually like companies or institutions owning single family properties was really never heard of. It hadn't been done. What do you want to do? We want to buy them at foreclosure auction. We want to go renovate them, and we want to operate them as rental portfolios. And that was the first time in that March of 2012 that I ever heard of that. I'm like, this is really something. I mean, at that point, the financial crisis just happened. Housing prices were just at the very beginning starting to tick up a little bit. But it was still a pretty tough time in this country. And to see private equity come in and scale and really want to go invest in this asset class was really great. And so I built up a team within Deutsche Bank to start financing those companies with loans that we were given from Deutsche Bank to finance their, basically you would call them now a fix and flip. Mm-hmm. I didn't even know the term actually at the time, but like it was effectively fix and flip on a massively institutional scale, would have like 8,000 to 10,000 properties, all of which we bought all over the country. Would finance those. So we did that first loan for Invitation Homes in October 2012. And then just started, we're kind of the sexy guys, because we figure out how to do this. Mm-hmm. And so we started doing again and again. So we got Apollo and Progress Residential, 510 Capital, and many other big private equity sponsors came to us. Ended up doing about $5 billion worth of lending in about a year, which is crazy.
Especially back then.
Yeah, that was a lot.
Yeah.
After $2 billion, to get $2 billion, they made me write a letter to the CEO of Deutsche Bank, promising them that I would be able to figure out how to securitize it.
A nice IOU.
I really mean it. I promise. And then after that, they said you got to sell the rest of it. So I syndicated out to all the other banks and everywhere on Wall Street that buy this stuff. Then in 2013, I went to the agencies and said, hey, we want to go get this stuff rated. And they had no methodology. If you want to go to the rating agencies, they don't just rate things. I mean, they have to have a criteria and a process and an established set of guidelines of how they're going to rate any asset class. And they've never done this for our asset class or any kind of single family rental properties. And so we spent about a year educating them and then on the process, ultimately getting Moody's and Kroll and Morningstar to agree to rate it. And then structure the first ever securitization of single family rental loans in really right about November 2013. So that moment was a crazy moment. So I'm a securitization guy. I've done a lot of Wall Street things. Normally when you sell bonds, you're in a room and maybe the biggest ever roadshow meeting I've ever had has like a roadshow is when you're going out and selling bonds. I would have 5 people in the room. We had like 270 people at the Invitation Homes roadshow meeting in 2013. It was like standing room only. We had like bouncers at the door stopping people from getting in. It was I'm like, does everyone know this is not the Google IPO? This is like we're just selling bonds here. But it just went to show the appetite from institutional investors to get access to the class, the excitement about something new, and getting involved in this was really, really huge. So then I left. I'm like, we got something good here. I figured out how to rate this. So I left Deutsche Bank and founded a company called B2R Finance. A gentleman named Jeff Tennyson, who was actually my partner and chief operating officer and president of the company as well. So that was great. Work with him for a long time. That was a company that would do portfolio loans on rental properties. So it wasn't one rental property at a time, but we'd do 5, 10, 100, whatever it was, bundle them up, make those loans as a group. Then we'd hold the loans ourselves and would ultimately the plan was securitize them. So we did that. We structured multiple securitizations and pioneered the first multi-borrower single family rental securitization. And that was my time at B2R. So in about 2015, I left B2R and wanted to go start something new. And so that's really the genesis of Toorak, which is my current company. So the idea behind Toorak is what we do for your listeners is we are not a retail brand. We're effectively the wholesale capital in the whole value chain. So we partner not formally with companies like Lima, but many other companies across the United States and United Kingdom to give them clear credit guidelines and credit criteria so they can go out and make loans, knowing that we're going to be there as a consistent and reliable capital partner for them. And then we acquire those loans on a flow basis. So they make the loan, then they'll sell them to us, and we'll pay them the loan proceeds, and they'll be able to make another loan and then grow their business that way. So that's the idea behind Toorak. And this space that we're in right now of we call it bridge lending, really at the time was untouched by institutional capital.
Right.
I mean, there was almost no money in this space. There was no one. It was people calling themselves hard money lenders. It had this sort of taint of almost being like payday lending or something that wasn't really established or accepted institutionally. And so there's really no institutional capital in space. We're the first people to really come in and scale and provide that capital to lenders, and it's been a great story since then for us.
Yeah, it's crazy that this space is really 10 years old, probably at max if you stretch it out. And like you said, when institutional capital, you being at the cutting edge of that in 2015, that was 7 years ago. So it's and I remember when you came to the office, I was a wee little boy, maybe a year and a half, 2 years out of college, and was called into the room. I vividly remember sitting downstairs in the conference room talking to you, and I was nervous out of my mind because we hadn't had, I was within the walls of Lima and at conferences, but I got a big, like, hey, be completely honest, transparent with these guys. It was impressed upon me the importance of this. So I was like, all right, here we go. Like, don't let me screw this up for everybody else here at this company. But yeah, you've really been a vanguard in starting this. And you talked about consistency and reliability. And as you look at our space right now, and this is the broader mortgage industry, but just looking at our niche in the BPL space, it's rocky. You hear of shops drastically reducing staff over the last few months. Plenty of shops going out of business or on the verge of going out of business. What are you seeing through that kind of quasi war zone that's going on right now?
Yeah, well, it's been a rough year. So I like to and I like to say that I hope we have a tough period. We're supposed to have like 5 to 7 years of easy times.
Mm-hmm.
I mean, I feel like we had COVID, which was really a horrible year. 2020, 2021 was a great year for our industry, and 2022 was pretty rough. It looks like 2023 is going to be rough as well. So we're definitely going through a tough time. I mean, we're seeing macroeconomically. I think everyone knows this. We're recording this in the middle of November of 2022, but massive rate increases. We've had 75 basis points rate increases at the FOMC meetings regularly. Likely be another 50 basis points in next month in December. That's been the most rapid piece of rate increases that's happened in, frankly, almost everyone's professional lifetime. You got to go back to the late 70s, 80s to see any kind of comparables. And when that happens, that means that rates have adjusted. Borrowers have to adjust pretty rapidly. A lot of borrowers are saying, "Hey, the rates are too high for me to be able to find good deals right now," and so the deal volumes reduced across the industry, and that's led to a reduction in volumes across the entire industry. And lenders in particular are particularly affected by that because ultimately lenders make their money by making more loans and getting points and fees, and it's really a per loan sort of system. And when that loan volume reduces, it hurts the entire industry. So we're seeing a lot of people have trouble. We've seen some layoffs in our space, and it's definitely been a tough time for people. But I think unfortunately, we're in it, and it feels like it's going to be this way for some reasonable period of time. I think before we get out of this.
Yeah, you and I have the pleasure of being part of the NPLA, the National Private Lenders Association, and we had a meeting in Vegas 2 weeks ago, somewhere around there. Yeah. And the sentiment was pretty consistent that, we're in the rough patch right now, in the thick of it. It's going to continue probably at least to sometime in the tail end of next year. And then maybe, perhaps tail end of next year, we see the clouds break. Is that, this is all reading the tea leaves and anybody's guess, but you're perhaps better positioned than most to read the tea leaves. So, the Oracle Beacham, what say you? Do you think that's kind of your best guess at when the clouds are going to break?
Well, you have to define a little bit what you mean by the clouds breaking, because a lot of people ask that question. They're like, are we going back to the way it was in January? And that's not going to be for a very long time. I don't even know when that's going to happen, but I think we're going to be at a period of higher rates. That period of higher rates is going to stay for a pretty consistent period of time. I think we're going into a period where housing prices are going to be under pressure. We're going to see housing. We're already in some markets have already seen it. That I think this is probably going to continue. It's almost certainly going to continue next year. We're going to see housing price declines in a lot of MSAs across the country. All those things are going to cause more difficulty and pain for our borrowers and our industry as well. So that's the reality of the macro environment we're in. I think if I were to pick a date, Halloween next year. It's not short. I mean, it's going to be some period of time. We need to work through this. We need to get to a point where rates are stable and clearly stable for a period of time. The capital markets start to function better than they're functioning. It's been an orderly process, but come back and sort of function a lot better. And once we have that, some stability, and by the way, it's not going to be the old rates, but it'll be a new normal. And then people get adjust to that. Housing prices will get to a new level. That's housing prices will clear. And then once we have some stability there, then people will get used to it, and then we'll have a new normal. So I think it'll take that long to get to that new normal, but that new normal will be at a different level than what we've seen in the past, or certainly the recent past.
Sure. I think with any kind of adverse event, adverse stretch of time, there's always some silver linings and positives to look to. What do you think those are right now?
Yeah, I think number one, it's nothing like the economic cycle to really focus people on credit, bringing us back to basics, underwriting, valuations, double checking the valuations. I think there's definitely enhanced focus on credit, process, procedure, underwriting to make sure the loans we're making as an industry are good and going to perform even during a stress period. So I think that's really good. I think the other thing that's really cool, I'll tell you, just from Toorak's perspective, we're using this as an opportunity to spend a lot of time, a lot of money on actually value-added technology.
Yeah.
Very, very cool stuff that we're doing in terms of simplifying the process, simplifying the review process of loans, all the work that we do. So lots of cool stuff can come out about that. So I think it's an opportunity for lenders to sort of look into their operations, say, hey, maybe the volume's not as high as it was for, but can I use this as an opportunity to retool myself, to ask questions about how I process loans in the past? Is there a better way to do it? Can I invest in new systems or things like that? And when people aren't as busy as they were before, it's a great opportunity to think strategically about what's going to happen when we come out the other side of this.
Yeah, it's very funny to hear you say that because you can tell you and Jeff Tennyson very similar philosophies, and this is one of the crossovers. I was sharing with you before we pressed record that we had a director's offsite a couple days ago, and technology was the chief topic of conversation for next year. It's technology and training and education for the 300 folks we have on staff here, knowing that it's not like COVID where lending is going to go down to almost zero for a few months. We continue to have healthy production, but what can we do whenever we're not busting at the seams as a company and as an industry? And it's perfect timing. Whenever you're busting at the seams, it's tough to advance deep technology projects, change LOS, do whatever you're doing, revamp your CRM, client portal, things like that. Like now's the time to do that. And like you said, this is cyclical. This is up and down. Talking about it before we press record. Like you have to have some thick skin, and if you're ready to pull out your hair and lose your mind whenever things start to dip, like maybe a different space might be the right fit. But it is, it's trying, but you have to have that global perspective of this is the space, this is the way it's going to work. It's going to come back. It's not going to look the same as it did, but COVID was the first. I don't put COVID as a downturn, more of
a shock.
Yeah, that's a good way to put it. So this is my first, what you would call a downturn, being part of it, and you just have to have that foresight to know that. I watched The Big Short after I signed my offer letter here, and I was like, oh no, when's this going to happen again? But it's just such a different environment, and it's part of the normal cycle. So there's some positivity there.
Yeah, just on tech. So the mortgage industry, especially our space, is very antiquated, very inefficient. We have a lot of manual processes, a lot of duplicative effort, a lot of wasted time. Just one example, just ask yourself and your listeners too, like if you run a mortgage company, if you're involved in this process, how many times from the time a borrower calls up someone in your company saying, hey, I want a loan, to when that loan is ultimately sold to a third party, that someone type in the address of that property? And that's something that probably, if you're honest, probably is getting typed in 20, 25 times across that process by different people. And they'll do it differently. They'll put California, they'll put CA, they'll put capital lowercase CA, like a lot of different variations on that. And that's a lot of opportunity to just do it once, right? And sort of not, duplicate this effort, not have all these manual processes, and just make the process much more efficient. So I think it's a lot. That's one example. There's many more.
Yeah, that's a big one though. I think oftentimes, efficiency gains are thought of as I have to do this massive overhaul of something, and really it's like just start picking away at how you can have gains. I lead a sales org, and we just did a new phone system launch, and we have a voicemail drop feature, and I calculated just to get some buy-in what the average time savings of that's going to be for a sales rep. It's like, hey, that's more time. I think it's 50 something hours a year it came out to. It's like if you can push virtually all of your voicemails through a couple of recorded ones you have.
That's great.
That's 50 something hours per person more that you can call.
That's crazy.
It's something so small that it doesn't take a lot of effort or lift. And there you go. So the perfect time to focus on that. As we close up, and I'm not going to let you come in here just for one episode. We're going to get 2 episodes up and down. But as we close up here, I want to talk through and just a little elementary education from me, and hearing your side of liquidity for lenders. Right? You have a lot of different options: banks and warehouses, secondary markets, and life insurance. I think those are 3 three big ones, but at a high level, walk me through those, and if you could add in kind of the current state and health of each, just to orient me and everybody else.
Sure. Maybe I'll start with the secondary markets first, and then go through the other ones. So, the secondary markets usually means selling your loans to someone like Toorak, or for us, it means accessing the capital markets. So, we have been historically an active securitization company. We've done over, I think, 12 different securitizations, totaling more than $3 billion worth of offerings, including both bridge and term loan securitizations. That market right now is pretty challenged. When we just give people a sense, when we did our first securitization on bridge loans, probably the average coupon, or maybe the last one, like a year ago, the coupon in that securitization would be 2.5%, 3%, where we can issue those bonds. Today, that's going to be 8% or about 8% if it's doable.
Right.
So just at levels that honestly don't make sense and are not economic, and it's open. There's deal availability there, but not at levels that we can actually make money and originate loans that borrowers actually want to accept. So that market is, in practice, not available for us right now, and not really a good source of liquidity. Similarly, on the term loan side, that market is open more, but still not really providing the best execution. So I'd say that market is very troubled. Still working, but not the best execution right now. The second is really banks and warehouse facilities. So we at Toorak are a very large borrower. Our company basically we buy loans and then we finance them in different ways. Right now, the bank market is a great market for us. We're actually accessing a lot of good bank debt from different banks around the country. A lot of interest in financing us. So we're very fortunate to be overwhelmed with opportunities to borrow from banks. So that market is functioning for us relatively well. It is a real primary source of our liquidity now. The third source is really life insurance companies, and life insurance companies are a great market. There's times in the market cycle where they tend to be really great. There's times in the market cycle where they tend to be not so great. Right now, they're really good period of the market. They especially like 30-year loans. So DSCR loans and other kind of term loans that we're doing in our space tends to fit more with life insurance companies. They have long-term assets, so those long-term liabilities, those long-term assets fit well with them. Less interest in bridge loans. But I would say what's happened is when the securitization market is not as efficient, a lot of that deal volume actually went over to life insurance companies. And so what we're seeing is a lot of those life insurance companies are saying, I've already filled up my capacity, I don't have any more. And so there's a finite amount of that capital available. But that capital has been pretty efficient. So I'd say that probably the most, if I ranked them right now, it's probably banks number one, life insurance companies number two, and the secondary markets are definitely the most trouble. It would have been actually the opposite a year ago.
Interesting. Yeah, when things were booming, the good times. Yeah, fair. So I enjoy, as always, getting a chance to chat with you. And we talked about really the lender side of the fence. And I think on next week's episode, we're really going to dive into stuff that's actionable and applicable on the operator side. So I'm going to pick your brain from all angles. Can't thank you enough for taking the time and sitting down and chatting with me.
Great. Well, thanks for having me.
Thanks, Sean. Thanks, everybody. All right. One down. How do you feel?
That's awesome. That's good.
Getting 2 episodes out of them.
Yeah. Give him my money's worth out of each.
You got me in April next. It could be a long run.
Efficiency gain.
There we go. All right.
Don't want to be too negative.
Yeah, no, not
but accurate. It's really bad. Everyone's firing.
It's a delicate balance.
I just walked to the DSCR floor. It looked pretty upbeat.
No, I was. Oh, geez, get out of here. It's a Friday before Thanksgiving. I'm shocked. We might have more salespeople here than underwriters here, which is on a Friday. It's a rarity.
Yeah, no, it's great. Yeah. I'm actually impressed. A lot of people are more than Toorak. Fridays are empty.
I know you flipped around your camera Friday when I was there. I think your assistant was there. That was about it.
Yeah, that's it. Mary's there. I'm there. Yeah, no one else.
Yeah.
But we require people Tuesday, Wednesday, Thursday. It's actually you pick a day. It's almost that's kind of an interesting thing. Maybe we should roll that out. You get one day, you pick it.
Yeah, it's been good here. It's been good to give some flexibility, and we've it's I appreciate the fact that it's so much easier on the sales side to manage remote activity than perhaps in other functions it can be, because it's very open. Come on, how many calls, quotes, submissions, and funded deals do you have? I can tell you that.
Well, as long as you have the tech. If you have the tech and you're tracking it,
Yeah.
You go in your system and say, hey, it looks like you didn't do shit all day.
Yep, exactly. But it's even though we have the 1 day a week, it's still a topic of conversation, because the tech side, there's not a one size fits all solution. I think an important piece is having a delegated authority to here's the minimum viable standard from a corporate standpoint, and if directors want to have flexibility outside of that, you can. It's like you know your people the best, and someone who, like a couple guys on my team, Drew, Bowen, who are consistent high performers. To be honest, I don't care if they're here quarterly for the company party or company meeting and on a beach of Tahiti the rest of the time. If they're hitting numbers,
you your numbers, whatever.
Yeah, it is.
But it's a morale issue for everyone else. So you kind of don't have equal standards, and you kind of let people leave early, and other people treat differently. Maybe you're sales, and you're like, okay, get this level, you can go all you want, and that's maybe a little more transparent instead of fair. But other departments don't have that sort of top producer kind of level that you can objectively identify.
That's it. It's like we live and die on leaderboards for everything. So it's you always know where you fall in the stack, and that's something that's pointed to. It's like, okay, if money is not your chief motivator, then autonomy and me not being on your ass and you getting, hey, you're producing, I don't care how many calls you make. If you make 10 calls a day and you produce $6 million a month, then all right, let's talk about how we get to 7 and 8, but I'm not gonna club you in the back of the head.
You're paying for yourself.
Yeah, exactly. There you go. All right, this episode, we'll keep it cruising. HPA, inflation, rents. So I'll just orient us to, just want to pick at some big features of the market, and
it's all good topics.
Yeah, wherever we can deep dive to. You mentioned the Phoenix market, and
that's particular. Boise is like something. Boise is like something. There's some weirdness there.
I want to ask you about Boise.
I just know it's like bizarre. I don't know what's going on there. It's something in the water or something. They're all like, they put some chemical in there, and everyone bids up the housing prices.
Yeah, I don't get it.
Yeah.
So we'll unpack what we can unpack, and we're certainly not going to get to the bottom of it.
I have a lot of insight. I just know we don't want to live
there. Yeah, we'll at least highlight this is an odd landmine. I don't know how to describe it. I won't say the word landmine, but all right, here we go. Just staring contest. Okay. All right, John Beacham, CEO of Toorak Capital Partners, joining me for another episode. I couldn't have you come into the office and just do one episode, so I'm going to steal more of your time and take another episode. You're too kind. Thank you for joining again.
Yeah, thanks a lot, Dalton. Super happy to be here. It's great to be in Greenville, and it's been a little time at Lima One here.
Yeah, so as we look at this week's episode, last week we talked a lot about the lender side of the fence, what's going on with lenders, capital providers, and really the formation of a lot of this space, which, as you noted, is really 10 years old, really, in its current form. And if you look at it from an institutional standpoint, you could argue that it's a smaller time frame than that. So still a relatively young space, but it has grown incredibly in those, depending on how you shake it, 7 to 10 years. And it's here to stay, which is a good, exciting thing, and something that, you, John Warren and John Thompson, are co-founders. Whenever y'all were, fighting the fight in the mid-20 teens, you had to convince people that this is an industry that is lasting. This is not a trade, right?
Absolutely. It took a while, actually, to convince investors and the markets that this is an asset class, just like residential lending, just like commercial lending. We sort of fit in the middle a little bit. As an industry, we're like, are we really residential? Are we really commercial? We're sort of both. I mean, we do business purpose loans mostly on residential properties, so it depends on your perspective and how you think about it. But it's the industry's come a long way. I mean, now we're accepted as a real asset class. We are an active securitization market for our asset class. There's many competitors, many institutionally owned, like Lima One. lenders in the space, and so it's definitely come a long way and become a really accepted asset class, which is great.
Yeah, that's been fun in my 7.5 years of being in the space, to be able to ride the uptick and I'm getting a little bit of the dip and going through that. But it's all good. Like the learning in this space, being in it throughout all of this growth has just been incredible. And I know if I, not a lot of spaces that I could have gotten into to see this and so much professional growth behind it. So it's been good and fun. Let's talk about some things from a market standpoint, and we'll have some broad Q&A, and I want to touch on a couple of specific markets. And let's start with, I'll say home price appreciation, but that's probably not the right term to use right now, so correct me, and talk to me about home prices right now. They are in, really, I think most everywhere, probably a flat or declining environment. So what's causing that? I imagine a big part of it is the fact that there has been ridiculous home price appreciation over the last couple of years. If you in March 2020, when the world stopped, if you would have said, hey, just wait a couple months and then home prices are going to skyrocket.
No one thought that.
That's insane. So we know the story of the up, and you don't have to be in this space to know that. I think everyone knows that home prices have been up. It's been such a headline grabber. Starting to come down. In some areas much more so than others. So talk to me about what's making some of the markets that are not coming down as precipitously, what's making those more stable markets, and what are some of the factors that you see leading to ones that point to maybe more of a drop off the cliff than others?
Sure. When I think about home prices, I think about three main drivers of housing prices in our country, frankly, in any country. I'll start with a good one, and then we'll work our ways to the not so good ones. But the good one is supply and demand. I mean, you have a reality, it's a market, just like any other market. You have a certain number of people, you have population growth, you have a need for new housing. And so you have a number of buyers in a particular market, a number of sellers, and there's going to be a clearing price that's brought to bear in the market. What we're seeing in our country is that we're massively underinvested in our housing stock for well over a decade, since the financial crisis. Ground-up construction lending is very limited historically in this country. It's very hard to find new land. We have a lot of zoning rules and various barriers to actually building new housing. So that supply of housing hasn't caught up with the population growth over the past decade. So we have just a lack of housing. That's not in every market, but that's in many markets across the country. And so that definitely is a positive. It's one real bright light in holding up housing prices. I would say what's happened today is frankly more of an almost artificial constraint on housing prices, because I'll tell you, my home mortgage, I got at 2.5%, beginning of last year. Obviously that's not available today. It's 30-year fixed rate mortgage. Sort of looks crazy today, but it also means that I'm not alone. Many people have done that. And so it makes it really hard to go move out of your house and go buy another house if your new mortgage is going to be 7%, which is probably the average rate today. Mm-hmm. The amount of, you're going from that 2.5% mortgage to a 7% mortgage, you're paying, I think it's something like 45% more actual payment every single month to go make that mortgage payment. And that means that a lot of houses are just unaffordable, and it also means a lot of people aren't going to sell their house. So that also exacerbates the lack of supply issue, because a lot of people just aren't going to move right now. That also means the same people aren't moving also aren't buyers. And so that's it's lack of transaction volume. So I think that's a really positive factor that's holding up housing prices. There's two really bad ones. Number one, we just mentioned, obviously rates are high, probably 7% average mortgage rate in the country. I'm talking not a business purpose loan, but on just a home loan for a normal human being.
Right.
That means you have to pay 40% more payment than you would have, a year ago. Means you can't afford as much house. So that's definitely a big negative. People just can't afford to pay the mortgage. Can't afford to pay as much as they could have a year ago, just because they don't make that much income. Exacerbate that with inflation. And inflation has definitely, made it harder for people to even, first you're going to buy food before you sort of buy a bigger house, right? So, the cost of everyday living, cost of energy, cost of gas, all the things we know about have gotten significantly more expensive. So it's harder for people to have disposable income to be able to afford that house. You have both of those issues. And I guess the third thing that's a pretty big deal, I think, is you have sort of like, after we did this one.
Yeah.
So Spider-Man, okay. And the third thing that's really a big deal right now is really just the employment situation in our country. So we are at peak employment right now, which is kind of weird because we feel like we're in this pretty scary economic period. But the unemployment rate's extremely low. Pretty much everyone who wants a job can get a job right now in the country. It means people feel pretty good about their employment prospects. The Federal Reserve is increasing rates. Part of that is to reduce employment in the country, reduce amount of people working. That's going to cause people to be less confident as we go forward into 2023 about their own employment prospects, probably higher unemployment rates, probably less wage growth than we've seen in the past. All those things, while now is good, are likely to get worse as you think through 2023. They're going to make it more difficult. So I think when you take the balance of all these three things, you got two really tough issues. You got one that's pretty good, but I think the two tough ones are definitely going to outweigh the one that's good. And we're going to see home price declines over the course of next year.
Yeah, I'm glad you mentioned supply because in my mind, anytime I think about the health of housing, that's a silver lining that I hold on to because overbuilding leading up to the 07-08 crash, and then it just fell off the edge and never came back to even remotely appropriate levels. Then you had COVID, which just halted any building, permitting, everything for, I think in most jurisdictions, at least 6 months. You just have lockdowns, nothing going on. Some major markets, much longer. So in a way, that supply issue, it's not helpful from an affordability standpoint, but you could argue that it's keeping home prices from just being a rock in a pond. So a little bit of a silver lining there for what it's worth.
Yeah, and that's listen, we're not making more land in this country. Obviously, duh. And we're not generally liberated. A couple states are exceptions. California is a great example, but our zoning laws are pretty restrictive generally across the country. And so it's hard to build more housing, so that's not going to change anytime soon.
Yeah. A couple of markets that have caught my eye from a headline standpoint, Boise, Idaho. That's one of the markets, and I'm going to, if I had to attach a word to the Boise market from a numbers standpoint, it would be odd. How would you respond to my attachment of that word to the Boise, Idaho housing market, knowing that it's a gorgeous area? Absolutely love it. One of my colleagues here lives out there, and it is beautiful, but from a numbers standpoint, it's odd, and I can't figure it out.
I'm not sure I have the answer to that question. I was in Boise actually a few years ago. It's a beautiful city, great. You drive outside of Boise, and there's endless emptiness. I mean, not far outside the city, it goes empty for a long time. So it's not like there's a lack of land in that area, which is normally what causes housing prices to really get out of whack. I'm not sure I know exactly what's going on in Boise, but it's definitely when we look at markets that are troubled, higher risk, I mean, that really, for us, is right at the end of the spectrum of the highest risk market in the country. There's others, I mean, Las Vegas, Phoenix, Nashville, other cities right now that seem, definitely troubled and probably going to have more declines than other places in the country. Those tend to be the places where the run-up has been higher as well. So you see the Northeast, I think, is actually relatively stronger than a lot of other areas of the country. We haven't seen as much run-up there during the last 2 years. Sterling's been good, but not like the rest of the country. And so probably less to fall there as well. So we feel like that's probably a little more stable. Some of these other markets, probably a little more risky.
Yeah, from an owner standpoint, it seems like again, going to a little bit of the reading of the tea leaves, but it seems that the pullback in home values is still going to be less than the last 24 months of run up that we had. So it seems like most markets are going to have values as we sit at any point over the next few months that are going to be higher than what they would have been if you would have had normal home price appreciation. Is that fair?
I think that's probably true. I mean, you should have a normal, it's not like we don't have people in the country who are working. and the employment situation is good. So the underlying reality of the home dynamics are good from that standpoint. It's a rate issue. So it really is going to depend a lot around how long these rates stay high, how long it takes to get to some sort of different level. But I think it's definitely going to be some declines, but probably not in below 2019 levels.
Fair. Excuse me. So looking, put yourself in the shoes of an operator in the space. An operator, just a real estate investor who has access to capital in the current period. If you're, you pick your shop up and go anywhere, invest anywhere with seemingly unlimited capital, what verticals are you getting into? You're looking at rental, multifamily, rehab, new construction. So from a product standpoint, what do you think is most attractive right now? And then from a market standpoint, what markets are on the other end of safety and security?
Well, I think generally all real estate right now is just like, frankly, a lot of the asset investment opportunities across the entire economy. It's definitely a riskier point than it has been in a long time. So I think almost all opportunities are less good than it would have been a year or 2 years ago. That being said, when you think about risk profile, ground construction is always higher. So that's one end of the spectrum. Tends to be longer time to get the project done, more cost variability in that, probably a little less certainty as to what the demand is going to be at the end, because you have a longer time before when you start digging to when you actually sell the property. So that's definitely on the riskier end of the spectrum. Short-term flips, you really have to be really careful about underwriting that deal to today's prices, not last year's prices, and also incorporate some sort of housing price decline into your models. So you're not assuming that you're going to sell for whatever today's price is. You're thinking ahead and thinking, okay, it's going to take me a year to get done. I need to go sell it after a year. You also got to think about inflation and cost inflation and wage inflation. And today's prices are not going to be the same as the price you paid last year to get your roof done. So realize you make sure you're using today's prices when you're actually underwriting it. That being said, if you find the right deal and you're really careful about that, you're taking a margin conservatism on your prices, you're taking into account current inflation rates and the current price of goods and services, you can find, we see lots of people finding really attractive deals right now that they can go buy, renovate, and ultimately make a profit on. So that segment, if underwritten carefully with today's reality, could make a lot of sense. If there are 100 deals a year ago, it's probably 40 deals today. But those 40 deals are still pretty good deals. So there's deals to be found. You've got to be a lot more selective in that space. I think probably the safest end of the spectrum is finding a rental property that's already leased up and you have rent in place, and immediately putting on a long-term loan on that. So you're not taking any risk between the time when you buy the property and when you're financing it. You can find a property that covers and the rent exceeds the interest payment by a reasonable margin. I mean, those are great deals. And you also get a lot of upside, because if you're financing that with today's rate, probably historically over time, that rate's going to go down. So you probably see a point in the next 5 to 10 years where that rate's going to be a lot lower than it is now. So you can refinance it out, which gives you a lot of upside opportunity for that. The second thing is on your rental properties, you're the winner from inflation. It's like everyone else is a loser. I mean, you're the landlord, so you're increasing your rents. So if you lock in a fixed financing cost and you're able to increase your rents by 5-10% a year, that generates a pretty attractive return for you as a landlord. So I think that asset class, if you're financing it the right way with long-term debt, makes a lot of sense. That's probably my favorite right now.
Where would you peg a minimum viable debt service? You see in our space some no debt service or sub 1 debt service products.
Am I a lender or am I a borrower here?
Yeah, let's say 2 very different questions, right?
Yes.
I mean, at Lean One Capital, we do not go sub 1. We're have been compared to some in the space, a little more conservative, and I think definitely to the benefit of us as a firm, and we like to think to the benefit of our clients. Like, we don't want to take back property ever based on the reality of large numbers. We take back properties. We do many hundreds of loans a month, and it's just a cost of doing business and part of doing business for us. But we would be happy with 0% default and just everybody pays the bills and everything's great. So we don't dip into that what we think is a little risky proposition. So I guess you teed it up for lender or operator, and I'll ask you to answer both. I'll be difficult.
Well, clearly from the borrower standpoint, I want to find a property that can cash flow, and I'm borrowing at a level that I'm able to pay my rent and have a reasonable cushion or margin of error on top of that. So I'd like to see a coverage of 1.1, 1.2. I mean, that's in practice hard to find right now at high leverage levels. But I would personally just take, what I would do is I'd put more equity into it. I would borrow less debt and make sure I have that debt able to cover at a reasonable level, knowing I always have the opportunity later, if rates go down, to refinance out that debt, take more cash out later and sort of have that upside opportunity. So that's me personally, but I'm probably a little more conservative. As a lender, same perspective. And we really like to see cash flow, like to see good coverage on the deals. Our average DSCR is probably, DSCR loan, a rental loan where we're lending to a borrower who has the property rented, and it's a 30-year loan. That probably is about a 1.2, 1.3 coverage ratio historically. It's hard to find those deals now because rates have gone up so much. But we like being that end of the spectrum and having some reasonable coverage level. If it's lower than 1.0, we've done those deals in the past. We want to see a materially lower LTV on those loans, not a little bit, like 10, 15 points lower, to compensate for the fact that you don't have coverage. Plus, you want to see a lot of liquidity from the borrower. Maybe they have an good employment income, maybe they have a lot of money in the bank. So there's actually a source for covering that shortfall on that property. But we try to avoid those, and that's a pretty small portion of what we've done historically.
Yeah, fair. Beacham, I always learn something when I chat with you. I truly mean that. You're somebody who, when I first got into the space in 2015, started going to conferences, started seeing you around, and you, John Hornick, other folks in the space, Tesh, have been incredibly, I think, kind, generous, impactful to me, and I've tried to soak up every nugget, every morsel I can. So it's we get to see each other, but not often enough, and I really appreciate you coming to do this podcast, but just being a good human and being someone who has just been there throughout the years, and I appreciate you.
Great. Well, thank you. It's great to see young people like you come in the industry, have a ton of success yourself, and sort of grow up pretty quickly and have a lot of advancement yourself. So congratulations on your personal success and the success of Lima One. You've definitely done yourself right.
Thank you. Thanks, John, and we'll get you back in here next time you're in Greenville.
Awesome. Thanks a lot.
Thanks, everybody. Take care.
Bye-bye.